Mayuresh Joshi as well joins in the show right now. Mayuresh, hi, afternoon. What was your takeaway from Nestle, ITC and Unilever's performance?
Afternoon, Aisha. Obviously, I think the volume growth that was anticipated by the markets, volume growth definitely has come a tad lower, both for HUL and Nestle as well. 2% for HUL, Nestle also 4 and 4.5%, a tad lower than what the street was probably believing in. But it was largely a combination of two factors, Aisha. One, the commentary surrounding rural discretionary spending expected to come back in a very moderate fashion. A large part of the analysts were believing in a very strong rural recovery in the second half, which obviously gives a huge impetus to FMCG players, both in terms of their volume and value growth. And if it's a moderate recovery, the expectations in terms of significant volume growth gets pushed back probably to the first half of the next financial year. Having said that, the kind of ad spend and the increases in ad spends by HUL, almost 11%, they will have to ramp up their ad spends. A lot of these FMCG companies, if they need to push their products through and their SKUs across price points in different markets and in different geographies as well, to probably ensure that volume/value growth happens at a reasonable pace. Having said that, valuations are again not too cheap for the space and within the space for HUL and Nestle. And therefore, I think the stocks might just go into a deep time and price-wise correction both as we see it. ITC, reasonable set of numbers as far as most of the business segments are concerned. Again, the underlying issue in terms of how cigarette volume growth will be in the next few quarters is going to be a very key facet to be watched out for. Paperboards should bounce back in the second half in terms of expectations of demand coming back strongly and expectations of price increases taking margins and protecting them as well. Hotel business, agri-business expected to do well in the second half as well. So ITC, relatively better placed, both from a number and a structural perspective as far as the next few quarters are concerned within the FMCG space.
Laurus. That's what everybody's saying. 406 rupees for Laurus. These are con call highlights. H2 priorities include higher capacity utilization across network to support growth acceleration. Markets are liking whatever I think they're indicating. And that spike, it was like a big spike in the last 10-15 minutes of trade, is reminiscent of what the numbers are. Mayuresh, do you track Laurus?
Yes, I do.
Mayuresh, there are very few things you don't track. I've realized over the years. How do you keep up, man?
I think God's grace and hopefully I think interacting with all of you keeps me on my toes.
So you did over the weekend also?
Yes, I
Come
do.
on, yaar. What cricket match? Do something else over the weekend. I had this habit of reading numbers over the weekend. I said, I'm not doing it now. Okay, Laurus now.
No, so as far as Laurus is concerned, I think two things happening here. If you go in terms of what the management commentary was a few quarters back, obviously the kind of pressures that they've seen both product-wise in their formulation synthesis business and the biologics business as well, that has meaningfully now got played out. They were expecting a second half recovery to probably come through. And therefore, sequentially, the numbers are a tad bit better as the street was expecting. I think 2-3 things here, Nikunj. One, I think in expectations of their custom synthesis business, the CS business as we know, and the expectations in terms of the NCE drug substances, they are having dedicated resources towards that, as I've been reading through their transcripts. So this is one element that can continue doing well and expected to do well in the next few years. There is expectation of gradual traction in their formulations business. And with the total reactor capacity for the API plant expected to go up, both the APIs and biologics can be additional support units as far as earnings are concerned. So I think Laurus is very interestingly placed within the pharma universe. We probably remain optimistic. A little bit of price strength is what will make us even more sanguine on the stock. And any positive management commentary, I think, will give boost to a lot of investors who are there and stuck with Laurus for a moment.
What do you make of the news in IGL, Mayuresh? How detrimental that could be?
So on one hand, Nikunj, I think the expectation is to take the part of natural gas portfolio in the overall economy from 6 to 15%. So I think more and more geographical areas will obviously get added on. On the other hand, what has probably happened in Delhi, I think we've been hearing about this time and again, but if this gets implemented in the coming year, the expectations for IGL, because they derive around 15% in terms of CNG sales, specifically from Noida and the NCR region. And it's impossible for one to presume that the entire 15% will go up. Even if the entire 15% probably goes up, the kind of hit that can come through in terms of both the EPS and in terms of cash flows onto their balance sheet can be anywhere to the tune of 300 to 400 odd crores. That is what the back of the envelope calculations is saying. The kind of correction that the stock has probably witnessed is far more in terms of the knee-jerk reaction that the market is probably meting out to the stock. So even if one assumes that entire 15% to go off, which I don't believe and think so, and the new geographical areas not ramping up to a certain extent, yes, numbers will come off, and probably the numbers which have come off, the stock correction has probably indicated that. But with this news, obviously a sentimental impact onto the stock.
Mayuresh Joshi, who would have thought a steel company in last 10 years would have given you a 9x return?
I think domestic steel companies are still holding out. I think I completely agree in terms of your thesis. The expectations that are now coming off is that a large part of the capex is largely behind us. I think some part of the capex is going to get carried forward in this financial year and the first half of the next, but the bulk of that capex is probably behind us. And with the expansions that are probably happening at its respective plants and the backward integration operations thereof as well, you're probably going to see a better EBITDA number on an absolute basis and on an EBITDA per ton that JSW Steel is going to produce. Again, I think it's largely a cyclical industry. We all know that, but a large element in terms of the infrastructure spending that is still expected to come through from the government side. I think that will reflect in better numbers for at least these domestic steel companies, where a lot of consumption might happen on local sources. And as prices recover on the LME, with China demand expected to come back in the next financial year, I think even the top line growth in terms of realizations for a lot of these ferrous players will continue to gain traction in the next year and a half as well. So yeah, I think domestic steel companies like JSW Steel can continue.
Right. Mayuresh, any stock or sector ideas that you're working with right now? Kunal was pointing out that from last month to now, we've at best just moved around in 100, 150 odd point band on the index, and even the small and mid cap indexes have not done a whole lot on a month to date basis, that is, or rather on a 1 month basis. Just wanted to understand, what are your biases both within the large caps as well as small and mid caps?
So cement and road construction companies, Aisha, I think they remain probably on our buy watch list. Within the large names, again, Ultratech is something that we continue to prefer at MarketSmith India. Large player, national presence, expectations in terms of carrying out the leverage capacities quite well. And again, I think not too much of debt onto its balance sheet as well. Within the same universe, in the mid-cap universe, Dalmia Bharat remains on a global focus list. Decent set of numbers that the company posted, an EBITDA of 955. And a small company in the Northeast, Star Cement, is also something that we like. They're expanding both their grinding and clinker capacity in the Northeast. Zero debt company at the end of the day. And expectations in terms of reasonable amount of volume and value growth should suffice strong earnings growth for players within the cement space. Road construction company is also very interestingly placed. I think the acceleration in a lot of infrastructure projects, and specifically road projects to be particular, is expected to continue in the next few years. A few of the lesser leverage companies like a KNR Construction, PNC Infratech, stay on our buy watch list at MarketSmith India on two counts. One, I think the kind of equity inflows into their existing EPC and HAM book is very, very minimal, and their existing cash flow should suffice for that. On top of that, minimal or no leverage or negligible leverage onto their books, which means as improvement happens in terms of execution and with better IRRs coming through, for most projects that they are executing, I think they will remain in a key focal area in the next few quarters as far as earnings growth is concerned. So I think a few of these pockets look very, very interesting.
Right. Okay, Mayuresh, great to have you on the show. Thanks as always for taking the time out and joining in.